Hi everyone. So recently I got asked what the difference between hedge funds, private equity, VCs, investment banks is, and I realized it's kind of confusing, like all this terminology if you're not working in finance. So I thought that I'd just do a really quick video on all these different groups. So let's start off with hedge funds. Okay, so a hedge fund, you know, think about pooling money. So kind of like a mutual fund. And essentially what we're looking at here is the money of high net worth individuals that want their money to grow. So we'll be investing in many different, you know, groups or many different types of companies. So what I mean by that is like we might invest in tech, we might invest in big pharma, etc. Because we want to diversify our portfolio so that if one sector is doing bad right now, the entire portfolio isn't necessarily doing bad. And there's high risk involved here. So I would say higher risk than private equity. And the objective obviously is to maximize the return. But I want you to keep in mind is in a short period of time, right? So we're looking at short-term profit potential where the liquid assets can be converted into like cash, bonds, stocks. And next, let's look into what is the difference between this and private equity. Okay, so when you think of this, look at this word, private, right? We're looking at investments made into non-public companies, right? So private equity firms can charge a lot of money because, I don't have access to these private companies. You may not have access to these companies either. So what we can see is we can only see public companies, right? Like Coca-Cola, Google, etc. And the private equity funds, it basically raises money from these investors to either buy assets, so buy assets that are not listed on public exchanges, and then use them to generate the money, or they can also buy entire companies that are doing poorly. So the key point here is that this industry kind of works with businesses that are already established. So don't think about startups or anything like that. This is already established businesses that just aren't public. And here we have like a long-term investment, kind of, right? So this is the difference. This is long-term, and hedge fund was shorter term. And it's long term because the funds are essentially like locked in, right? And there's also a consulting side to this where the private equity firm can kind of suggest better practices to these private companies. And the advantage of them here is that, if these private companies implement these strategies and it does help them, then the private equity firm will get higher returns on their investment, right? And you're like, okay, what is the risk involved here? Well, the risk is that these companies are not public, right? And what does that mean? Is that they don't really have to publish their financials, right? And this means that the investors are expecting higher returns because there's less transparency, right? So I'm going to write less transparency. Okay, so next let's talk about venture capitalist. So this, when you think about these guys, immediately think startups. Okay. So this firm will invest a large amount of money in startup in exchange for part ownership of the company in form of some sort of equity. So for example, Uber had some VC investors that invested early on, and now like the little amount or whatever they invested in the early stages, they got a portion of the company, and now that's worth a lot of money. So we want to be investing in these high potential companies. And the companies will then, like these startups, will then, of course, use this money to, they'll be using this money to hire more people or work on their inventory or whatever is necessary, work on their PR and stuff like that, right? But what people don't realize is that there's actually a lot of pressure for these venture capitalists, right? Because there's lots of different venture capitalist group, and essentially they're competing against each other to land these deals. So something you might see on television, which shows like Shark Tank, is you're seeing that like all these different startups are coming in, and they're trying to kind of get more investments and stuff like that. But what happens a lot is that the VCs are kind of running after these founders, right? I mean, it's obviously it's not happening in every case, but I'm just saying it's happening more than we realize, because basically these VCs are getting paid based on how much money they manage, right? So they're paid based on amount of money managed, right? So you want to, as a VC, like you want to be managing as much money as possible, right? So you have this incentive to give money, essentially, right? If you can justify to the investor that this is a good business, then you want to be able to get that investor's money and put it in, because that, as a fund manager, gives you more money, right? So often what the problem is that there is a lack of auditing in the preliminary phases, right? And this can lead to a lot of problems. I mean, what basically happens is the investors and the VCs, maybe they're not asking enough questions, maybe they're not looking into it as much, because these things will slow down the investments, and the VCs can risk losing the deals to other VC firms that might not be asking these questions and might be making it easier for the startups, right? But the problem with this is companies you may have heard of, like these two, and their founders right now are in jail because they essentially just they did fraudulent trials, and they weren't questioned enough. All right, so another group I want to talk about is investment banks, and these guys are going to be specializing in like companies selling or making them public. So there's different divisions, right? Like we have the asset management division, and these guys are basically just using the bank's money to invest in markets. So kind of like, I guess you say, like hedge funds. And they are also making money for the clients by managing their, so essentially, yeah, the same thing, right? So they're investing in markets for their clients. And another group is going to be our IBs. So you may have heard, IBs are working crazy hours, and what they're actually doing is they're putting together deals. So what exactly are these deals? Well, they're evaluating the company, you know, really meticulously, focusing on what are the goals of this company and trying to get the offer from the company. So what happens is these IBs, they have to make a pitch deck, right? And these companies will go to a bunch of different firms, right? And they will hear this pitch deck from a bunch of different firms. And so obviously the pitch deck that is most well written, most specific to their company, meets their needs, etc., they will go with that company, right? And these investment bankers, their whole job is to just make the deal. So that's where the hours kind of go in, because these guys are essentially like, if we're selling the company, then essentially we're just like real estate agents, right? But for companies. So I can give you an example of a popular investment bank that you may have heard of, Goldman Sachs, right? And they have their divisions like investment bankers, which we talked about. They have global markets, which didn't talk about, so I can quickly go over that. Global markets division, they raise funds, right? They're buying and selling goods. They're also working with risk, etc. We have the asset management division, which we did talk about. We have the consumer and wealth management division, and this group is essentially consulting for these high net worth individuals. So how can they invest their money? How can they save themselves from paying extra taxes, etc. Right? And there's always like consultants in these groups, and essentially what a consultant will do is, first of all, they have to figure out what the problem is, right? So there's a lot of talking to the client, a lot of back and forth, figuring out, all right, what exactly is this problem, right? Are there too many people in the group? Do we need to lay off people? Something wrong with manufacturing, etc., right? So figure out the problem, then we make the plan. And the plan is, like, we need to divide the teams. So, for example, we can have PR, manufacturing, auditing, how many people are involved, essentially make like a whole timeline, right? And then we need to negotiate. Sorry about that. Oh, I'm not sure why that's happening. Yeah, so negotiate. This is the last part. And so negotiating means, so we're dealing with this client, right? And the client has to pay for this problem to be fixed. And we might say, all right, like, I am going to be solving this problem or making this plan, etc., in X hours. So you need to pay me for the hour, and that's the deal that I'll be making. And yeah, so I hope that helped. I talked briefly about consultants, investment bankers, the hedge funds, and venture capitalists, private equity. If you want me to go over things in more detail in another video, please do let me know. I love talking about this stuff. So yeah, thank you so much.